Tom, I want to start with you just on the fixed income side. How closely you're watching this play out in corporate earnings?
Yeah, well, very closely. And really what the feedback from corporate CEOs is telling us is that they believe they have pricing power. That is, they look at the consumer pipeline and they see the price pressures on their producer side, on their corporate side, and they're saying, look, we think we finally have some pricing power. And that confidence in and of itself is a direct change from what we've seen in the last decade. So that's very important. And we look to those comments because that confidence is very important to us.
Kristen, are you focused on the same thing? Because we've had many people come on this program recently say pricing power, pricing power, pricing power. We want a position for those companies. Are you doing the same?
Absolutely. And this is why we're looking very, very closely at earnings and fundamentals. This whole discussion around input pricing and the ability to then basically give that to the consumer, right? So to be able to pull that out to the consumer, we haven't seen that yet in terms of pricing power. But given all of the concerns around inflation, that's really what we're expecting in the second half of the year. And then it goes back to, from a portfolio positioning standpoint, where do you invest if you're worried about those rising costs ultimately?
Where do you invest, though, Kristen? Just give me some details where you would go.
So what we're doing, yeah, absolutely. So this is where it's really tricky, right? Because it's not like there's a great place to hide within fixed income markets, within equity markets at the current level. So one of the areas that we've been looking at are those areas that, both from a valuation standpoint, free cash flow generation standpoint, that are actually quite positive in this market. So we're looking outside the US, and there's markets, for example, like the UK, like the Eurozone, where you don't have that mean reversion priced in, you don't have that COVID recovery. From a PE multiple standpoint, actually quite attractive. And from a dividend yield standpoint, you're looking at about 3 to 4% in some of these, with some of these companies and in some of these regions. So when you're trying to bridge that gap, when duration can be punitive, when cash can be punitive in an inflationary environment, we're actually looking outside the US at those high free cash flow generating, high dividend paying companies.
Tom, Kristen going through the equity side of things, doing a wonderful job of exactly that. Can you walk me through the fixed income side of things, how you would express this through fixed income right now?
Yeah, there's not a lot of places to hide in fixed income if you're looking at a rise in inflation. The best you can do is kind of hope to, we'll call it, clip your coupon and avoid any sort of further selling or losses from duration risk. So that means you got to shorten your duration, move down the curve on investment grade. We still like, and we've always liked, short duration investment grade corporates. We'll say an A- rated 2-year to 3-year piece of paper still performs reasonably well in that environment. But you got to supplement that with a little bit of lower quality credit, but you can't take on too much duration. So what that means is bank loans, leveraged loans. And now we go back to an earlier point I made about this being close to a Goldilocks credit environment. And I don't want to overstate that, because there's always risk on the horizon. But nonetheless, bank loans should, from a credit standpoint, should also perform well in this environment. And you also have rising rate exposure because of floating rate exposure there.